Hi, everyone. I'm Ben Norton, and I'm joined today by a good friend of the show, the political economist Radhika Desai. And we are talking about her book, Capitalism, Coronavirus, and War. This is a multi-part series. There are so many interesting ideas that Radhika explores in this book. And today we're going to be talking about chapter 4, which is on neoliberalism and its financializations. I want to remind everyone that you can follow along in the series and read Radhika's book for free. You can download it, and I'll put the link in the description below. And we're actually going to do this in two parts. So in the first part, we're going to be going through the history of the rise of neoliberalism, going to the modern era, the contemporary era. And in particular, I do want to ask about the issue of stagflation in the 1970s. What caused it? What are the lessons we can learn from it? And what are the similarities to today? Now, for people who don't know, stagflation refers to simultaneous economic stagnation and inflation. And today, there are economists who argue that we may see a similar period of stagflation like the stagflation of the 1970s. But Radhika, I want to begin, before we talk about the parallels to today, I want to talk about the rise of neoliberalism in the 1970s and in particular in the 1980s. This is most well known in the figure of Margaret Thatcher, who became Prime Minister of Britain in 1979, and then Ronald Reagan became President of the United States in 1981. And you, in your book, point out that neoliberalism, the idea, which essentially is free market fundamentalism, this is not something that was born in the 1970s. You point out it existed, in fact, for many decades. In particular represented really by the Austrian school of economics, of people like Hayek and von Mises. And essentially, these free market fundamentalist ideas were fringe. They were completely fringe until the 1970s. And you point out that it was the crisis of stagflation in the 1970s that gave rise to to essentially the Austrian school of economics and eventually the monetarists and Milton Friedman becoming mainstream, this previously fringe idea, because essentially capitalism was in the monopoly stage, and there were two solutions: further socialization of capital, turn toward more socialist policies, or simply the free market fundamentalist era of neoliberalism, removing all restrictions on capital. And that, of course, led to an ensuing financialization we're going to talk about today. So that's how you begin the chapter. Can you lay that out in further detail, why you think neoliberalism did eventually reign supreme, what caused the stagflation of the 1970s, and what were the two paths that could have been taken, and why was the neoliberal path taken and not the more socialistic path?
Okay, so that's a lot of questions, and if I forget any one of them, please remind me. But let's begin with neoliberalism and its origins. So as I understand it, and as I have discovered in writing not only this book, but many other things that I've written, in fact, going back to my MA thesis, which was precisely about these neoliberals and the think tanks that they had created back in the mid-1980s. But leave that aside, I've been sniffing at this trail for a very long time. So to summarize what I've discovered over the decades, basically you have in the late 19th century, circa 1870, you have the emergence of something called neoclassical economics. And this is what's generally taught as, if you go to university today and you take economics, what you'll be taught in your undergraduate economics degree, the mainstream economics, which is still predominantly taught, is some version of neoclassical economics. However, even this neoclassical economics, when it emerged in the work of three quite different people. So apparently what happened is that three different people, Stanley Jevons in England, Leon Walras in Switzerland, and Karl Menger in Austria, they all independently came to rather similar conclusions. Now, I should add that we have talked about the emergence of neoclassical economics in these series before, but in the past, when we talked about it, we were talking about its emergence as a challenge to Marxism. So, and to classical political economy. And what I said is that what happened by the late 19th century is that with the increasing presence of an increasingly organized working class, essentially, even classical political economy of people like Ricardo could not be allowed to continue because they said dangerous things like all value comes from labor. So if all value comes from labor, then why are capitalists and landlords appropriating so much value becomes a natural question. So it had, some new type of understanding of the capitalist economy had to emerge, and it did emerge, and that was neoclassical economics. Now, in general, we tend to put them all in the same box, but I should say that Stanley Jevons didn't really make much of a mark. He was kind of very scattered sort of thinker. He was not particularly theoretical, but Leon Walras and Karl Menger certainly left very big legacies. So Walrasian version of neoclassical economics is typically the one that tends to assume that there is ultimately, in the long run, equilibrium in the economy, so that all the forces of supply and demand balance each other out, and there will be equilibrium and everything will be fine. The Austrians were in many ways much cleverer. And I'll tell you why they were cleverer. Because if you insist that the capitalist economy naturally leads to equilibrium, and then you see that in reality it does not, there are regular crises, there are regular mismatches between supply and demand, for example, and other forms of other problems in them, and equilibrium is not obtained, or if it is obtained, it does not last for very long, etc., then a critique emerges very quickly. But if you say instead that no, there is no guarantee of equilibrium, anything can happen, then in fact the endorsement that you give to the capitalist economy is that much more secure. And that's the Austrians for you. So they do not leave hostages to fortune, like claims about equilibrium. They simply say that the free market economy, which allows market forces their full play, which essentially means allowing those who have property to do, what they want with their property, and everything else can go to hell. Their claim is that that sort of economy, free market economy, is the best, will give you the best outcomes you can expect, even if you don't think they're very good. The point is, you'll never get anything better. That's their argument. So it's these forms of economics are born in the late 1870s. But remember that although they very quickly get adopted and start being taught, in the early decades, they are still facing, there are still enough people who are around who were schooled in classical political economy. There was the German historical school, which retained elements of classical political economy and so on. And so there was a certain sort of resistance there. And then by the time you get into a decade or two later, you also see the rise of institutional economics. And then, of course, eventually in the 20th century, you see one of the biggest critiques of neoclassical economics emerging in the form of Keynesian economics. So John Maynard Keynes, who is originally schooled in the Marshallian version, that is to say, sort of the English school of this neoclassical economics, and he accepts it, but increasingly he begins to realize, particularly because Keynes's thinking is very deeply connected with making policy. He always wanted to make policy relevant interventions. So based on the difficulty he had of understanding what was really going on in terms of neoclassical economics, he essentially produces a massive critique. And I like to say that a couple of things about Keynes, and Keynes and Marx. Number one, if Marx was the greatest critic of capitalism in the 19th century, I would say Keynes was the greatest critic of capitalism in the 20th. Secondly, that there's actually a lot in common. Unfortunately, we have a situation in which people who are Marxists want to show how radical they are by disdaining Keynes, and people who are Keynesians want to show, how elite they are by disdaining Marx. But in reality, there's a lot in common with these. But I don't want to say too much about it. I just want to say that and leave it there. So Keynes's critique is a very radical one. And of course, as we know, through most of the middle of the 20th century, his kind of economics dominated. So it's only when the Keynesian welfare state economies of the 50s, 60s, and 70s fell into the crisis by the 1970s, and people began to, of course, there were Keynesian explanations for the crisis, but because Keynesianism was associated with the old regime, they tended to get dismissed. And that is when the neoclassicals got their chance. Now, this is also very interesting, because what that tells you is that it took almost 100 years of the continued existence of free market economics, particularly in the form of Austrian neoclassical economics, for free market economics to finally have their day. And I should say one other thing. Free market economics was always, was throughout the post-Second World War period, very embattled. And in one of the previous episodes, I'm sure we've talked about this fact that at the end of the Second World War, everyone thought that the world was going to, or most informed people thought that the world was going to take a radical lurch to the left. And we've discussed how, although the world did not become socialist, there was some truth to this expectation, because communist countries were communist. In third world countries, they were distinctly leftist developmentalist programs. And the first world countries, the homelands of capitalism, had Keynesian welfare state regimes in which basically capitalism was heavily modified in a variety of ways through full employment policies, welfare states, etc., etc. So substantial state ownership. So anyway, the point is that this expectation of the hopes of many people and the fears of people like Hayek, that at the end of the Second World War led Hayek to launch what we know as the Mont Pelerin Society, essentially a society of people, free market economists like himself, which was funded by some small-time industrialists and so on. And these guys, they ended up keeping the faith, sort of keeping the flame alive until the crisis of the Keynesian system. And when the crisis occurred, then these little think tanks that had been obscure little places, hammering away and producing, what most people would have considered absurd ideas, suddenly began to get a hearing in the 1970s. And Mrs. Thatcher in particular was converted to the thinking of Friedrich Hayek. Apparently, she used to take his Constitution of Liberty and slam it down in front of her civil servants and said, everybody's going to have to read this book, etc., etc. In the end, of course, actually, even Mrs. Thatcher's reign was not as free market as the free marketeers hoped, but they got a hearing. And the post-Second World War period was the crisis, in the context of the crisis of the Keynesian welfare state regimes, you got essentially a situation in which the ruling elites faced a choice. The choice was, shall we shall we continue? Shall we deepen the socialistic Keynesian welfare state measures that we have taken so far and that have done so well by us, giving us 2 to 3 decades of the most sustained growth that the world has ever experienced? Shall we just deepen these reforms, or shall we roll back these reforms on the basis that the problem is in fact these socialistic measures? So this was a very fateful crossroads at which the West stood. And essentially, the people who argued for the second option, which is you should roll back these socialistic reforms because they are the problem. They are shackling capitalism and the free market, animal spirits of entrepreneurs. You should let them loose and allow whatever, allow the dynamism of capitalism to be restored. So this choice was made, of course, not without a fight. If most people who actually remember the 1970s will remember them as a decade during which there was a great deal of social strife. There was a lot of industrial strife, particularly strikes and lockouts and so on. First world economies were, of course, in the grip of stagflation, as you've already mentioned. There were disruptions of various sorts. There was also terrorism. Of course, there was the protests against the Vietnam War, etc., etc. So all of this stuff, in fact, there was so much popular discontent expressing itself freely in the streets that you actually had a report commissioned by the governments, essentially the capitalist elites of the 3 major centers of capitalist accumulation, Japan, Western Europe, and the United States, actually writing a report saying that the first world is suffering from too much democracy, because essentially implying that a certain amount of authoritarianism was in order to quell these demonstrations. The 1970s were a decade of contestation. But out of that contestation, it is the right that emerged victorious. And I should also add that I would say that it emerged victorious, obviously for complex reasons, but one very important reason is that, as we've already discussed, the left was already on the back foot because it had already compromised too much with neoclassical economics, free market economics, and economics that assumed that somehow capitalism was eternally dynamic and productive, and so on and so forth. This, as I've said before, is a Schumpeterian conception, not a Marxist conception of capitalism. But anyway, so these guys, they won the battle. And so beginning in the 1980s, you saw the installation of the neoliberal policy paradigm. Obviously, in the economy that had already become so so controlled by the state, which had been run on fundamentally different principles, the installation of neoliberalism did not happen overnight. There was a process. There was also much resistance. So beyond a point, there are certain types of neoliberal reforms that could never be undertaken. So let me give you one obvious example. Last week in Britain, they celebrated the 75th anniversary of the National Health System. The National Health System is a publicly owned, publicly provided system of. It was set up as a publicly owned, publicly provided system of healthcare, which would be free at the point of use. So anyone who was ill could simply go to an NHS clinic, hospital, etc., and expect to be treated at no cost to themselves. So obviously, Mrs. Thatcher would have loved to privatize this entire system, to essentially dismantle its socialistic, statist character. But she could not, because it was something that has been much loved and continues to be much loved by the British public. But what the neoliberals were able to do was to hollow it out from within. So they introduced contracting out of various services. They introduced, of course, they underfunded it, so they ran down. So right now, for example, at the 75th year of the National Health Service is plagued by nurses' strikes, doctors' strikes, you name it. Practically everybody who works for the National Health Service seems to have a problem because their wages, despite the heroic efforts that they have made during the pandemic, their wages have stagnated for decades. So anyway, so I'm just giving you examples of the sorts of ways in which neoliberalism was implemented. But broadly speaking, the direction of policy in our economies, in the first world economies, since that time has been in the neoliberal direction. So a couple of other points and I will end here. So, the idea, like I said, was that neoliberalism was going to revive capitalism. It was going to free the energies of capitalist entrepreneurs from the shackles imposed by state regulation and social obligation and taxation and what have you, and all these would be lifted, and a capitalism would return to being dynamic and etc. But you see, this did not happen. And I also argue that it could not happen for a very simple reason. Even when neoliberalism was born in the late 19th century, capitalism was already becoming monopoly capitalism. It had essentially completed its competitive phase, and it was appearing, the result of a competition is ultimately monopoly, because what happens in competition is the most successful players outcompete the others, and then they are the only ones left. And then you have, in every sector of production, one or two large firms dominating the entire sector. So we had already entered that phase. Now, the whole premises of neoliberalism in all its forms, I would say, but certainly in its Austrian form, relies on the notion that competition is still operating in the way that it used to, when in the competitive phase, when all firms were price takers and not price makers. Now, yes, if you had a competitive capitalism, then there would have been more of a restoration of dynamism, perhaps. But the fact of the matter is that we already had monopoly capitalism. To give more freedoms to monopoly capital in this fashion would have only led to essentially to encouraging them not to display the virtues of vigorous competition, but the vices of senility. So essentially giving monopoly capital the freedoms that we have given them over the past 4 decades, freedom from taxation, freedom from regulation, freedom from all sorts of things like that, from state ownership, blah, blah, and so on. All of this has simply encouraged them not to invest and to return to a productive, to productive dynamism, but rather to actually increasingly financialize, because they have no desire to invest. And there is one final reason, which is that neoliberalism is very anti-labor. It restricts the right of labor. It wants to roll back strong unions, etc. Now, when you are anti-labor, what you do essentially is you create the conditions in which wages will stagnate. And one of the key insights of John Maynard Keynes, as also of Marx, is that if you restrict the wages of workers, ultimately you are restricting the market. The market is not going to be as big as it would be if workers were able to earn a healthier wage. Of course, ultimately it will never be big enough, but it will not, neoliberalism restricts the market even more. So with very bad market conditions and monopoly prevailing in capitalist in all pretty well all sectors of capitalism could not regain its mojo, no matter how much freedom you gave them. Indeed, the more freedom you give them, the more they were going to show the vices of senility, which to me ultimately amounts to financialization, because what you want to do is you want to make money without producing. You want to make money without making an effort. So that's my story of where neoliberalism comes from and why it failed to revive capitalist economies after the onset of the stagflationist period.
Yeah, I think that was a very great description in a nutshell of the rise of neoliberalism going back over 100 years. Now, Radhika, I want to talk more about the 70s and this moment of stagflation, because in the book, you point out that growth rates were higher in the Keynesian era, which is also known as the golden era of capitalism, when there was much more state intervention in the economy. There were capital controls, there were currency controls, and there was much more robust growth in this period than in the neoliberal period. But you mentioned that in the 1970s, there was a crisis of the Keynesian system, which was stagflation, simultaneous inflation and stagnation. What do you think the main causes were of the stagflation in the 1970s?
Sure. Now, that's another really large question. So once again, feel free to follow up. But let me begin by talking about why people were surprised at the coincidence, the simultaneous appearance of inflation as well as stagnation. The reason for that is very simple, because throughout the previous many decades of Keynesian macroeconomic management, it was sort of a rule of thumb that you would have a trade-off between growth and so therefore when you had growth, you would inevitably have a certain amount of inflation. And if you clamp down on inflation by essentially pursuing restrictive fiscal and monetary policies, then you would essentially create a certain amount of stagnation. The thing about the post-Second World War period is that on the whole, these episodes of inflation as well as stagnation were quite moderate. So you may have a certain amount of inflation, but it was considered manageable, and there was a far greater tolerance for inflation than there was. One of the features of neoliberalism, by the way, is the installation of a very high degree of intolerance of inflation, and we can come back to that later on. But so the general idea was that if you allow growth to happen, you will inevitably get a bit of inflation. Growth and inflation go together, and then if you clamp down on inflation, you create disinflation, you're going to have a little bit of stagnation. But they tended to even out each other a bit. But then what happened is you got inflation and stagnation together. This was not supposed to happen, and this is what caused the surprise. Now, I would say that the reasons why this crisis of stagflation occurred were actually many. So maybe, let's cast our mind back to one of the earlier episodes when we talked about how, in critical understandings of capitalism, of which Marxism is in the forefront, but there are many other compatible critical understandings of capitalism. You can, these critical understandings have produced a complex understanding of capitalism. And in that, people agree that there are actually many causes and mechanisms that create crisis in capitalism. And in this book, as in a couple of previous works, what I've tried to do is I've tried to systematize the causes of crisis, which occur either because of the way in which the relations among capitalists are organized, namely through competition, or they occur because of the exploitative relation between capital and labor, or capital and all forms of producers, whether they are actually wage labor or sometimes even independent producers. But so these mechanisms, two mechanisms, one vertical, one horizontal, create crisis in practically every realm involving capitalist production. Every given capital, so there are many possible sources of crisis. What's more, any individual crisis will likely have a complex combination of many crisis mechanisms working at the same time. So that's the crisis of the 1970s was no different. The crisis of the 1970s, according to the explanation that I favor, which it basically argues that essentially we had a crisis of the 1970s because the expansion of productive power after the Second World War reached the limit of existing demand. Now, both points are important. So on the one hand, of course, the golden age was a very expansive phase of growth where producers in all the three main centers of capitalist production, of course, expanded their productive capacity. But at the same time, this remained in an underlying fashion a capitalist economy. And that meant that ultimately a capitalist economy does not allow demand to expand as fast as production. So ultimately, the limit of demand is reached. So definitely, paucity of demand was one major cause of crisis. Number two was, of course, declining profits. So profitability, as numerous people who do statistics much better than me have shown, profitability of Western corporations was continuously declining through this period. And with that, of course, went also both the declining profits as well as bad demand conditions also tended to bring down the rate of investment. There are other issues as well. So there is, of course, the whole issue, which has been made prominent by the writings of Robert Gordon, who is an American economist, and he argues that essentially the innovations that powered growth were more or less kind of exhausted by the early 1970s. So thereafter, it's not that innovations have stopped, but they have not been quite as great as as conducive to growth as in the past. So there has been also a slowdown of technological innovation. Furthermore, of course, people would say, well, if demand was saturated and there was not enough demand, where did the inflation come from? Well, this is another fundamental misunderstanding, and it arises from the way in which capitalist economies in particular manage inflation, or let's say conduct monetary policy. What do I mean by that? Well, in a capitalist economy, essentially, people say that inflation is too much money chasing too few goods. And so typically what the capitalist monetary policy maker does is he says there's too much money. And he says we're going to essentially reduce the amount of money available to people. So that includes not just restricting money supply, but it also includes essentially creating such a level of unemployment, such a level of restrictive monetary policy, so high interest rates and so on, so as to induce a recession. And so instead of actually tackling the demand problem, you actually create a recession, which then essentially reduces demand, because if enough people are unemployed, if enough people are not getting enough wages, then of course demand is going to fall. And so they essentially impose a recession or contraction on the economy in order to deal with inflation. The American economist Robert Solow called this practice, said that this practice was equivalent to burning a house to roast a pig. I mean, you'll get a roasted pig at the end of it, but you've burned down your whole house. All you had to do was turn on your oven. But the problem is the capitalist economies cannot turn on the oven, because the equivalent of that would be to actually tackle the other side of the problem, which is to say, okay, why is too much money chasing too few goods? Why are there too few goods? Why should not we encourage, either, regulate so that private capitalists produce enough goods, or if private capitalists won't do that, the state can step in and supply the goods, whether it is food or housing or transportation or whatever it is that is increasing in price. So, but of course, to start doing that would be to challenge the very fundamentals of a capitalist economy, which is that the private sector, just by acting on its own devices, will provide all of us with what we need. They don't aim to provide us what we need, but inadvertently, this is the capitalist view, inadvertently they will provide you with what we need, and that's the holy grail of capitalism. You cannot disturb it, etc. So anyway, this way of dealing with inflation eventually meant that Paul Volcker induced a massive recession, both on, when he increased interest rates in order to tackle inflation in the United States. So in that sense, money and monetary policy was a problem. But it was also the case that the inflation was in fact not necessarily coming from, was the causes of inflation were not confined to the first world countries. A part of the inflation was also coming from the fact that third world countries were increasingly in a position to demand better prices for their products, because they had been through a couple of decades of development. And that in itself should not have been a bad thing, because at the end of the day, what is the purpose of development? It is to make wages higher, because that's what you want. This idea that you get development by reducing wages is bonkers. You want to have, the whole purpose of development is to increase wages. And similarly, it is also to increase the prices that can be earned by small producers, whether they are peasants in the third world or are small business people elsewhere, there or elsewhere. So there is also there is this whole point that essentially the imperial power of the first world countries to compel third world countries to sell the products of their labor cheaply on world markets was declining, and that should have been also taken into account, but they did not. So in all of these ways, it was a complex crisis, crisis of profitability, crisis of demand, crisis of imperialism, crisis of essentially, management of money, etc., etc. So in all of these ways, there was a crisis. Instead of tackling the complex crisis in a complex way, there was essentially a one-size-fits-all policy, neoliberalism. What does neoliberalism say? You must reduce government spending, you must reduce the power of labor, you must reduce state ownership, you must reduce welfare, social expenditure of all sorts, you must restrict, you must decrease taxes, particularly on the rich, because if you decrease taxes on the rich, then they are going to invest and create jobs for everybody. These are the fictions. But this sort of one-size-fits-all policy was one after another adopted in various Western capitals. And in the context of the debt crisis, which was created by Paul Volcker and his interest rate increases, the debt crisis of the third world, which meant the third world countries went to the IMF and the World Bank in order to borrow money, because they suddenly needed vast quantities of money in order to continue repaying their debts and retain their credit. By the way, Fidel Castro told them to repudiate their debts. They were odious debts, but they did not have the political will to do so. But nevertheless, the IMF and the World Bank, in the guise of the structural adjustment programs that they imposed on third world countries in return for lending this much needed money, essentially imposed neoliberalism on third world countries. So neoliberalism was imposed across the board. So I hope that answers your question about stagflation. Like, why did we get stagflation? You got stagflation because it was a complex crisis of capitalism. And then, of course, neoliberalism treated it as though it were a very simple crisis.
Yeah, that analysis is so important because you actually provide a systemic analysis of what caused stagflation. It was a product of the actual capitalist system, the way it was organized, and not simply a variety of different factors that were transitory. Because if you listen to the way most economists discuss the stagflation of the 1970s, they typically blame it on two primary factors: the cost push inflation of the oil lockout of OPEC, which caused oil prices to skyrocket, and the dollar and commodities prices tend to be inverted. So as oil prices go up, the dollar tends to go down in value against other major currencies. And then the other factor that especially neoliberals, monetarists like Milton Friedman popularized is they blamed labor. As always, they always blame labor. Their argument was in the 1970s, labor was too powerful. You mentioned, for instance, the Trilateral Commission, which published this report on the crisis of democracy. By the way, it was co-written by Harvard University star Samuel Huntington, who also played a role in the Jimmy Carter administration, which you could say actually ushered in neoliberalism even before Reagan. It was actually Carter who appointed Paul Volcker, another neoliberal acolyte, as the chair of the Federal Reserve. So, I mean, you can see the early foundations of neoliberalism being laid here. But anyway, the point is that in the 1975 report on the crisis of democracy, Samuel Huntington and others, they also claim that labor is too powerful. Labor unions were too powerful. You mentioned the protests and such going on. And of course, the response of the monetarists like Milton Friedman is to say that because labor was too powerful and wages were too high, you had demand pull inflation, too much money chasing too few goods. And therefore, the way of dealing with inflation is destroying the power of labor, reducing their wages, breaking the back of unions. And this is exactly what happened in the 1980s under Reagan, right? So that is the simplistic analysis. But you're actually pointing out that essentially capitalism, the progressive role that capitalism played historically was decades before. Capitalism was already at its sell-by date in the 1970s in the monopoly era, and the stages were set for more and more socialization of capital, which we saw even in some parts of Western Europe. I mean, not to exaggerate, but there definitely were a lot of socialistic policies. I mean, you mentioned in Britain, one of the greatest policies Britain ever created, which is the National Health Service, and how that was like the peak. That was one of the greatest victories of the working class in Britain. And ever since then, the ruling class in Britain has been just whittling away at the NHS. So anyway, the point is, I mean, I think you're absolutely right about that. I want to talk about another significant factor that you discuss in detail in this book, which is the end of Bretton Woods 1. So in 1971, US President Richard Nixon ended the convertibility of the dollar into gold. This goes back to the Bretton Woods Conference in 1944, which set a rate of $35 per ounce of gold, making the dollar as good as gold. That ends, Bretton Woods 1 ends in 1971. But that is only part of the story. You point out in this chapter that in 1974, Richard Nixon also lifted capital controls, which had been imposed in the late 1960s in order to deal with the increasing difficulties that the dollar faced. And in addition to that, you also had the OPEC oil lockout, in which oil prices skyrocketed up to 4 times their previous value. And in order to try to stabilize the dollar in this very unstable geopolitical climate, you mentioned that Henry Kissinger had this Machiavellian diplomatic coup where he persuaded OPEC oil producers, in particular Saudi Arabia, to deposit their oil surpluses as dollar deposits in US and other Western financial institutions, and at the same time lifted capital controls in order to facilitate this. What this helped lead to the creation of is what you and Michael Hudson have referred to as the world dollar creditocracy. And you point out that it ushered in a new era of explosive growth in dollar-denominated financial transactions. And given their sheer volume, downward pressures on the dollar, which had been depreciating because of all the inflation, downward pressures on the dollar were now counteracted by expanding financial demand for the dollar. And this meant that dollar-denominated international capital flows would expand in leaps and bounds to ever greater orders of magnitude, reaching a peak when? In 2008. So you point out it wasn't just the toxic mortgage-backed securities and other toxic securities that set the stage for the 2008 crash. You point out that the seeds of the 2008 crash were actually laid in the 1970s when the Nixon administration lifted capital controls in order to try to strengthen the dollar by increasing demand. But all it did was set the stage for increasing financialization and this big bubble that would eventually explode 50 years later. I mean, I've kind of explained your point already, but maybe you can expand more.
So Ben, those are really good questions, and I'd love to say a little bit more about all those things in addition to what I've said in my book. But let me just say something about what you started out with, because it's really, there's a huge truth buried in the debate that you mentioned earlier, which is what most economists blame inflation on. And you rightly pointed out they will either blame it on what they call cost push inflation, so it's like primary commodity prices are too high, or they will blame it on wage push inflation, so wages are too high. But if you think about it, if these are the things that cause inflation in capitalism, then it tells you that capitalism is kind of finished. Because remember, what's the point of having any kind of economy if it does not allow people to live better, which means people who have historically been poor, if it does not allow for the improvement in the conditions of working people in capitalist countries and of working people in third world countries. So, when the prices of, I don't know, coffee or wheat or generally food or whatever, or for that matter, oil, go up, what that tells you is that the people, the workers of these countries or these countries themselves are able to demand a higher price for these products. And in fact, that should happen. If in order to maintain capitalism, you have to clamp down on wages and push them down further, you have to clamp down on primary commodity prices and push them down further, what kind of a system is that? Essentially, it's a system that relies on the poverty of a lot of people. So that's the thing you have to remember. If that's the only way you have of dealing with inflation, in reality, you should be able to deal with inflation by expanding production without affecting the advance in the living standards of workers or primary commodity producers. But this is not the option that we have taken. And I think many people today, people who are working, people who are striking in such large numbers today, will find this very interesting and important. So, okay, let's turn to the end of Bretton Woods 1 in 1971 and what this has to do with the repeated financial crises of the time. Of the time since. It's really important to remember that actually in the period of between the end of the Second World War and the 1970s, this was, this period of the Keynesian welfare states in first world countries, and what I call the period when socialistic measures enabled the golden age of growth for these countries. In this period, one of the key policies, one of the key institutional features of this period was the widespread adoption of capital controls, which meant that while capital could flow across borders, governments monitored these flows, and they did not permit most flows of capital across borders. Capital markets were national. This situation was nicknamed or was labeled financial repression by those people who thought that this was a bad thing. But for the world as a whole, this was a great thing because it allowed governments to manage economies with a view to full employment, to productive dynamism, etc., and also to things like rising wages, to broad-based prosperity, etc., without having to worry about the effect of that on the exchange rate, etc. They allowed people to manage the internal economy without worrying about the effects of this on the external economy and so on, which meant that essentially governments had a lot of policy autonomy. So this era of financial repression enabled vast growth, and it also was an era in which, thanks to the restriction on capital flowing unrestricted across borders, it was also an era of great financial stability. There were hardly any financial crises, currency crises, banking crises of the sort that we have become so used to in the last many decades. So now, what I do in this book, as well as in my previous book, Geopolitical Economy, and in various other writings, including the one you mentioned that I wrote with Michael Hudson called Beyond the Dollar Creditocracy, in a whole bunch of these writings, what I've tried to do is I've tried to show that the financialization that we have witnessed in the neoliberal era, which is essentially a great expansion of financial activity, essentially increasing indebtedness on the one hand and increasing speculation in asset markets, which seem to go up no matter how badly productive economies are doing. This type of economy is actually deeply connected with another aspect of the post-war period and our current situation, which we have not yet mentioned, and that is the role of the dollar as the world's money. So very briefly, I think we've mentioned aspects of this in the past, but let me give you a capsule version of the story. So essentially, in the early 20th century, American policymakers begin to nurse the ambition of having the US dollar replace the pound sterling as the world's money. They can see that the role of sterling is weakening, and they think, oh, well, if they can do it, so can we. We are going to make the dollar the world's money. Unfortunately, there were many things wrong with this vision. Number one, the fact of the matter is that sterling was an imperial currency. The UK was able to make and keep sterling the world's currency because the UK had access to vast reserves of vast surpluses from its empire, which it was able to export to other countries, such as the United States itself, by the way, which throughout the 19th century and the early 20th century was a giant sinkhole for capital, which these capital imports into the United States accounted for its great industrialization, as also the industrialization of many other countries in Europe, in North America, which is to say US, Canada, and then of course the Antipodes and South Africa and so on. So these were the places where the capital went, and the capital was extracted from places like British India and Africa and the Caribbean and so on. So this type of system worked because Britain was an imperial country. The United States is not an imperial country. The United States had, especially given that after the Second World War, the United States was competing with the rest of the world in order to maintain the size, both absolute and relative, of the US economy. It had no capital to spare. It wanted, it certainly wished that all the capital it had would be reinvested in the American economy in order to keep up its relative and absolute size. So there were no capital exports. People often talk about the Marshall Plan. Marshall Plan funds were puny compared both to what Europe needed and what of course, what had gone as capital exports in the past. So this is Marshall Fund is no counter argument. Marshall Plan is no counter argument. So essentially, then the United States could only provide the world with liquidity, essentially make dollars available for the world to use by running deficits. I should also say, I've mentioned before that the United States, the world did not want the US dollar to be the world's money. The United States gave the world no choice but to accept it by essentially rejecting the plans that were brought forward at Bretton Woods to have a very different system, which hopefully we'll talk about another time. But Keynes proposed this International Clearing Union and Bank Code. The US rejected that, imposed the dollar on the world, and then proceeded to provide the world with liquidity, that is to say, with dollars, not by exporting capital, which would have been at least more stable, but by running deficits, essentially writing IOUs and issuing dollars to the rest of the world in payment for what the United States was receiving from them, whether it was goods, but also it was essentially the money that it spent or in its military activities abroad. So these deficits, as these deficits grew, people began to see a problem. And the famous Belgian economist Robert Triffin pointed out that, look, this is not a sustainable situation, because the fact of the matter is that you are providing liquidity by running deficits. But the bigger your deficits are, the more liquidity you provide, the less the rest of the world wants your dollars. And sure enough, between 1960 and between roughly 1958 and 1971, the European countries refused to take dollars for their exports because they ran export surpluses with the United States. They refused to take these exports, the dollar, and they said, no, give us gold instead. You've promised to exchange the dollar for gold at $35 an ounce. We'll take it. We'll take gold. So essentially, gold drained out of the United States in this period. In fact, it was mostly gone by 1961, so it didn't take that long. And thereafter, the United States tried to engage in a number of stopgap measures to try to keep the convertibility of the gold going, but eventually it exhausted all possible attempts. And by 1971, it had to say, sorry, folks, we can't exchange the dollar for gold anymore. Thereafter, lots of people thought that the dollar's world role would be finished and gone, but the United States since then has essentially landed on an extremely volatile, dangerous, and also ultimately unsustainable way of keeping the dollar as the world's money, which is what you were saying, expand financial activity, because the downward pressure on the dollar comes from the fact that the US is running trade deficits and current account deficits. But if you expand financial transactions, then the world, you essentially give not so much the world, but at least the rich people and institutions of the world a reason to hold dollars. Because what you're saying is that you can, we may not have much to export to you, but if you hold dollars and invest them in our financial system, then you will make money through financial transactions, either by lending or through speculation. So essentially, the United States opens a kind of vast casino, a sort of a casino come loan shark business, essentially. And that's the way in which the United States, by essentially counteracting the effect of the Triffin dilemma, by expanding world demand for dollars in the form of financial activity, the US has counteracted the Triffin dilemma. So this has meant ever expanding financial activity. So beginning in the 1970s, financial activity has expanded. There's a graph in the book that you can see, but financial activity has expanded constantly. And each expansion has ended badly, creating a crisis for the world. So the initial expansion, which basically involved accepting accepting petrodollars and then lending these petrodollars to the third world, essentially creating a vast expansion of bank lending to third world and some even communist governments at the time. All of this lending took place in a context where the interest rates were very low and even negative, and this could take place because, as you were recalling, when OPEC increased oil prices in 1973 and again in 1978, what happened was that Henry Kissinger essentially persuaded them to not to allow the oil surpluses to go towards, say, a European or Japanese plan to recycle oil surpluses by allowing the oil surplus countries to lend money to these countries so that they could buy the higher priced oil, but rather said to them, deposit them in US and generally other Western financial institutions that were increasingly becoming part of this big financial US dollar denominated financial system, which began expanding at this point. So these banks suddenly began getting vast quantities of deposits. Well, if you're a bank, you may think that, having vast quantities of deposit is a great thing, but you've got a big worry. You have to pay interest on these deposits. How are you going to pay interest on these deposits? You're going to have to lend them out, find people who can borrow this money, make enough out of this borrowing so as to pay you back. That would be the ideal situation. But anyway, they essentially ended up lending to governments on the ground that governments never go bankrupt, and essentially lent a lot of money to these governments. And then when Paul Volcker raised interest rates in the 1980s, money that was borrowed at near zero or sometimes even negative real interest rates was suddenly these debts were valued at vastly more because real interest rates went up massively. And most of these borrowers essentially couldn't pay, and you got the big third world debt crisis. So that's how the first big expansion ended. Then you got a vast inflation in the US stock market, which ended with the 1987 US stock market crash. Then you got the various, money started flowing out of the United States looking for opportunities for profit making elsewhere. So you got currency and banking crises in Mexico, the so-called tequila crisis, and in Russia, and even in places like Sweden, and in the early 90s in Britain, in other advanced industrial countries, you began to get these crises. Then the culmination of all that was the big, giant East Asian financial crisis. After that, you got the dot-com bubble because money then flowed into the US stock market, particularly in the tech stocks. That came crashing in 2000. Then you got the buildup of the massive housing and credit bubbles that burst in 2008. And of course, now we are sitting on post 2008 on a giant everything bubble. So anyway, that's the general story. But what I also point out is that there were two key moves that were made by the United States to create the condition for this. The first move was that the United States lifted capital controls in order that all these petrodollars could start being recycled in the 1970s via US and affiliated banks, which accepted these petrodollars as deposits and started lending so freely around the world. So lifting of capital controls was the first thing. And the second thing was the Volcker shock. So lifting of capital controls essentially certainly opened the way for money to flow into the US dollar-denominated financial system. And in the 1990s, of course, the US tried to persuade a whole lot of other countries to lift capital controls as well. And they, of course, that meant that they became vulnerable to these crises as well. And the second thing was the Volcker shock, because what happened along with the Volcker shock is that a very fundamental principle of banking and of generally credit relations, of debt and credit relations, which is that debtor and creditor are co-responsible for a bad loan. I mean, if things go well, nobody worries about it. Money is borrowed, money is repaid, everybody's happy. The borrower made a lot of money. Out of the lot of money he or she made, it was paid back. Everything is good. But when loans go bad, people say, whose fault is that? And generally speaking, it has been held that borrower and lender are both. They have a problem. If you lend the money without due scrutiny, it was your problem too. It wasn't just the borrower's problem. Well, this principle of creditor co-responsibility for bad debts was completely thrown out of the window. And since then, the world has been running on the basis of essentially what Michael and I call a creditocracy. That is to say, a world of financial relations, of debt and credit relations, in which creditor is king and the borrower is nothing. But that is exactly the sort of recipe for disaster and a recipe for productive strangulation, the strangulation of the productive economy. Because in any decent economy, you should have essentially a situation in which the borrower, namely the entrepreneur who borrows money in order to invest it, should have a certain position. And this is completely negated. And this is part of the fundamental problem with the kind of economy that neoliberalism, with which the dollar system is intimately connected, is linked.
Yeah, Radhika, I think this episode historically is very important to understand how we got to the moment we are today. And of course, with the 2008 financial crash and all of the ensuing consequences, it's important to go back to the 1970s to see the foundations that were laid for that crisis. And you make an interesting point in this book. The narrative that we've often heard about the third world debt crisis is that with the recycling of all of the petrodollars from OPEC producers, especially Saudi Arabia, they're depositing their oil profits in dollar deposits in US commercial banks and also buying US Treasury bonds. And then with all of that, the excess deposits in the commercial banks in the US, they begin lending at very low interest rates to countries in the global south largely. And the argument that we've often heard is that this essentially fueled a lot of corruption, right? That, it's part of this myth that corruption is somehow more endemic in the global south than it is in the global north, when, I mean, obviously there is corruption in the global south, but it also very much exists in the global north. Look at insider trading in the US Congress. I mean, it's absolutely rampant. But anyway, the point is, the blame is put on the shoulders of people in the third world, saying that they're simply corrupt. They're hopelessly corrupt. But in fact, you point out in the book that when in the 1970s, when inflation was high in the United States and there was all this borrowing happening, all this lending happening, because the interest rates, in many cases, the real interest rates were effectively negative or very low because the inflation was higher than the actual interest rates. This actually did help to fund a lot of industrialization efforts in the global south. You point out in the book that the global south, that is the developing world's share of world manufacturing, increased from 7.6% in 1970 to 10.2% a decade later in 1980, whereas at the same time, the developing world, the global north's share of global manufacturing, declined in the same period from 71.1% to 63.2%. And this was, for a lot of countries, in my case, being more familiar with Latin America, with countries like Brazil and Mexico and Argentina, this was a major boom for industrial development in these countries. There were a lot of good industrial jobs. And the neoliberal era not only financialized the US economy, it also financialized many of these third world countries' economies that were trapped in debt, like Brazil, like Mexico. And still today, I mean, a lot of these countries are dealing with essentially the same problem as then, with this debt they simply can't pay off. And now with rising interest rates, again, there are a lot of historical parallels. But you pointed out in the book, Radhika, a fact that is not that well known. The idea of US banks being too big to fail did not begin in 2009 with the bailouts of the banks. You point out that in the 1980s, as the US Federal Reserve under Chair Paul Volcker is massively raising interest rates, and that means that it's extremely difficult for countries that have borrowed that money to pay it off, especially in the global south. They can't print dollars. Their currency is devalued against the dollar because of the rising interest rates, so it becomes harder and harder to service the debts. Well, what that also means is, because each loan has two sides of the balance sheet. It's an asset for the bank, and it's a liability for the people who is borrowing the money, right? So the bank's assets also decrease in value, which is something that we're seeing today with the rise in interest rates. So many of these banks in the 1980s, with rising interest rates, became insolvent. And in response, there were basically two policies you mentioned to save the insolvent banks. One, of course, the IMF and the World Bank came in and imposed the neoliberal structural adjustment policies and austerity on the debtors in the global south. But you point out that also, essentially, this was the beginning of too big to fail, that banks that were basically insolvent, like Continental Illinois, were essentially nationalized temporarily and bailed out by the US government. So this, I mean, is another example of one of these historical parallels that is so similar to what we're seeing today, where with these constant crises, you mentioned so many of them, these constant crises in which the lifting of capital controls and neoliberal policies and deregulation creates a big bubble, and that bubble explodes. We see that again and again and again in the past 50 years. And you also point out that in response to this 80s crisis, banks in the US were afraid of lending directly. So instead, they began to securitize debt. And this leads to the creation of things like mortgage-backed securities and the toxic securities bubble that, of course, blew up in 2008. So, I mean, again, we see it an example of how these policies in the 1970s, the lifting of capital controls in 1974, and eventually the implementation of neoliberalism, all of this set the stage for the problems we've been dealing with ever since the 1970s. And I think it really goes a long way to explaining why we're in the situation we're in now, where just this year, 3 of the 4 biggest banks that have collapsed in US history have collapsed just this year alone. So, I mean, a lot of people would say, why haven't they learned? But of course, they have learned. The thing is, the ruling class is in crisis because they understand that in this moment, the only solution out of the crisis is a return to more socialistic measures, which means that the capitalist class is going to lose its profits. So that's why they don't learn, because it's in their economic interest to not learn. I'm wondering if you have thoughts there to wrap up.
Sure. Again, lots of really interesting questions. So let me just begin anywhere, but I do want to end with the learning part. Okay, so let me first of all say that, because they essentially are associated with the rejection of the idea of a creditor and lender co-responsibility for any debt that has gone bad, what we have is a tradition that we have established of always blaming the debtor. So that's why, coming out, as a result of the third world debt crisis, the stories began to float, the mainstream media, as well as, by the way, mainstream scholarship. They're all the same. They all began to peddle the idea that the debt crisis was a result of the fact that there was massive corruption in third world countries. But as you rightly pointed out, there is massive corruption pretty well in all the major capitalist economies that we can see. What happens in third world countries is you get a lot more retail corruption, small petty corruption. But in every major capitalist country, third world as well as first world, what you invariably have is grand corruption, grand larceny, massive corruption. So millions and billions of dollars changing hands through insider trading, through using through taking advantage of your official position. So, how many presidents, prime ministers, ministers, etc., go on after the end of their term in office to take very lucrative positions in big corporations and so on. This is a form of corruption because it's not quite quid pro quo in the sense that, you give me this and I give you that, but it is as good as that because that's the expectation. So there is corruption everywhere. In the capitalist world in particular. Socialist countries we can talk about separately where there may be corruption, but it signifies something very different. But anyway, so there is of course corruption, but this is really, it had less to do, the fact of the matter is that in the 1970s, first world banks were desperate to lend. They were touting their loans. There's a wonderfully funny book called In Banks We Trust by Penny Lernoux, which was talking about how lending within the first world, lending generally in the 1970s essentially took the form of boozy lunches in which people would write loan contracts on table napkins. That's the kind of, carelessness with which lending was done, because quite frankly, you had to lend to somebody who could vaguely promise you to return, some sort of return, because otherwise you had no means of paying interest on all these deposits that you had taken. So the real issue is, people say, oh, these poor third world countries need our lending. No, you need to lend your money to them in the first place. Why? Because since the 1970s, one of the things that I forgot to mention earlier, I did mention earlier, neoliberalism never resolved the problem of growth and dynamism. Throughout the neoliberal period, you have had lower and ever lower rates of growth and ever lower rates of investment. In this context, if you want to lend, then you can't lend to first world businesses. So you are going to have to find other people to lend with. And the prime borrowers have been third world governments, third world corporations, and also, of course, household debt and so on. So anyway, the point is that you always blame the debtor, but in reality, the creditor is also has been desperate to lend, and you have had the United States and its dollar system and its neoliberalism and financialization have created a world of loan touts. How many unemployed friends do we all have who have been sent applications for credit cards? Please apply and we will give you a credit card. So this is the kind of thing where we've come to. Okay, so that's the first point. You also pointed out that the too big to fail issue. Yes, absolutely. The first time that the expression too big to fail was used was in relation to Continental Illinois. Continental Illinois was one of the banks that was endangered by the third world debt crisis. But as I said, the IMF and the World Bank, acting as bailiffs for the dollar denominated financial system, essentially created a situation in which the creditors who were part of the problem would be bailed out, and the burden of repaying the debt would be placed on third world governments, who, of course, essentially had to then create the conditions in which third world producers were working harder and harder to export more and more. And of course, all third world countries produce like products. So all of them are exporting this more or less the same things together, whether it's coffee or cotton or cocoa or silk or what have you. And naturally, they are flooding the markets with this. The prices are falling, so they have to work harder and harder to make the same amount of money. I mean, it was tragic what happened to third world countries, but all of this was very breezily put down to corruption. Anyway, continental Illinois got bailed out. And this was the first time too big to fail was used. You mentioned something else, something about learning. You know, back in when Paul Volcker raised interest rates, you didn't actually have a situation in which banks would suddenly not have liquidity because you see, right now the problem with SVB and other such banks occurred because their assets, which they are now required to keep thanks to post 2008 legislation, which was aimed at increasing the resilience of the banking system, they are required to keep X amount of treasuries, essentially US government debt as part of their assets. And essentially they have invested in these, and they invested in these long dated treasuries, assuming that the interest rates would remain low, and therefore these bonds would retain their value. But then as inflation returned, and we'll talk later about why inflation has returned this time, but as inflation returned and the Federal Reserve did the only thing that it permits itself to do, which is start jacking up interest rates, these securities became useless, and as a consequence, the bank went bust. But back in the 1980s, banks first of all did not go bust because apart from continental Illinois, they were all, they were all not, they didn't have to be bailed out by governments, because essentially the imposition of the principle of debt of responsibility ensured that third world governments continued to pay back their loans. And in the end, they have ended up paying many times the money they borrowed, which they had borrowed in a low interest rate environment, and they're now repaying in a very high interest rate environment. So the banks didn't go bust, but you are absolutely right about securitization. So, we have this expression in English, once bitten, twice shy. So the banks realized that if they, when in the future, having, been rattled, if not destroyed by the experience of the third world debt crisis, in which, yes, if the IMF, the World Bank, the US, and other first world governments had not acted in order to impose the principle of debtor responsibility, these banks would have gone bust. But they didn't go bust. They were saved, but they said, okay, we got saved, but now we'll not get back into that situation again. So what did they do? They essentially changed their lending practices. So the old lending practice was the bank would lend you money, and therefore the loan would remain on the bank's books, that you have lent, X country so much money, and this will be paid back over time, and so on and so forth. And if it wasn't paid back over time, the bank was immediately in trouble. So now, in order to avoid that, if it was big enough, the old expression that if you owe a bank $100 and you can't pay, you are in trouble. But if you owe a bank $1 million, or maybe these days $1 billion, and you can't pay, the bank is in trouble. So the banks knew that. So they said, okay, we are now no longer lending with loans that sit on our books. What we are going to do is we're going to float bonds. So essentially what they do for every lender is they securitize the loan. So imagine a lender wants to borrow $1,000. So you say, okay, we are going to float 100 bonds of $10 each, and we'll buy a few of them, but we will also offer it to the rest of the public, and then they will buy, we hope that they will buy them. So that's how and of course, once you put out that loan, you may have a certain rate of interest tied to it, but the value of the bond may go up and down. If people think you are a great prospect, they will buy the bond for much more than you are offering them for, and that will bring down the effective interest rate you have to pay. And if they don't like it, they may increase the interest rate you have to pay, but whatever. The point about securitization is that you don't have to sit on a loan. You don't have to keep a loan until maturity. If you feel that this lender to whom you have lent through these means, through bonds, is not looking very good tomorrow, you can sell the bond. At least that's the idea. The problem is that so this idea is that you are going to reduce the risk to which you are exposed. But first of all, the moment any problem actually appears with any lender, everybody knows about it. In most cases, people know about it. So in fact, at that point, everybody is trying to sell their securities relating to that borrower. In that case, suddenly the market freezes up and you actually can't sell it to anybody without incurring a big loss, without taking much less for your bond than you had been willing to pay. So this idea that somehow bonds are safer is itself problematic, except in very, very limited circumstances where the market for that bond is still liquid. You know something about this problem that other people don't, etc. That's why insider information is so important. But anyway, so that's how they started securitizing lending. And this is the fundamental fiction that lies underneath the securitization process, the idea that somehow by securitization you are reducing the risk. This is a false idea, and that is why we got those big bond crises that we began to get with the mortgage-backed securities and so on with the 2008 financial crisis, because you were actually not spreading risk at all, and nor were you diluting risk for any given lender either. The fact of the matter is, at the end of the day, it is not particular securities that are liquid or not, it is markets that are liquid or not. And if a certain market for a certain kind of bond, if everybody knows that bond is in problem, then suddenly the markets are going to freeze up and there'll be nobody who wants to buy the bond that you are so desperate to sell.
Yeah, I think that's a good note to end on. I mean, the way that these things are so flippantly discussed by, neoliberal ideologues, as if securitizing something inherently makes it more stable. I mean, it's the complete inverse of reality. And the 2008 crash is staring everyone. The reality is staring everyone in the face, and it's increasingly difficult to ignore that. As today we see similar crises, they're not exactly the same, but as we see again, 3 of the 4 biggest banks in U.S. history that have collapsed, or at least that were allowed to collapse, have collapsed just in the past few months. So, in the next part of our discussion of chapter 4 of Radhika's book, which is Neoliberalism and its Financializations, we're going to be talking about the situation today, the parallels to the stagflation of the 1970s, and the long downturn. Radhika discusses the long downturn in her book, which is, the golden era of capitalism was the Keynesian era. And we've discussed today how growth rates were actually quite stagnant in the neoliberal era. And especially since, with the 2008 crash, there has been stagnation economically around much of the world. And, we're still living with this long downturn that we've been in since the rise of neoliberalism. So I want to remind everyone that you can follow along in this series and read Radhika's book for free. You can download it, and I'll put the link in the description below. And it was made available for free as a PDF thanks to the support from the Knowledge Unlatched Foundation. Radhika, is there anything else that you'd like to plug before we conclude here?
Yeah, actually, that's I'm glad to have that opportunity, because I just realized that I missed an important thing in the last thing I just said, which is you asked a very important question about learning. And that is very central to my book, because, I argue in my book that most economists tend to talk about capitalist economies in the simple present tense, as though all its dynamics are cyclical. Whereas in my book, I give a historical account of that dynamic, because I feel that the dynamics cannot be cyclical, because capitalism continuously runs into crisis. And as it runs into crisis, capitalist states have had to continuously manage these crises. Obviously, the role of some states, like the US state, which is quite very powerful and runs this international creditocracy, or casino, as I like to call it, casino plus loan shark business. The role of that state is, of course, much greater. But the whole point of a historical account is to account for learning. So, for example, after spending the 1980s and 1990s, urging all governments to lift capital controls. The very heavy incidents, the IMF and the World Bank spent the 1980s and 90s asking everybody to lift capital controls, but the heavy cost of financial crisis after that did have an effect on the World Bank and the IMF, particularly because the record of their own interventions in these crises led many countries to conclude that these were essentially outfits that worked in the interests of first world countries. So this was a correct conclusion, and IMF and the World Bank could see that many third world governments were withdrawing from it. Its loan portfolios were shrinking. So they did, in fact, end up admitting that, yes, a certain amount of capital account management would be allowed. So that's an instance of learning. And in the present case, in the case of the securitization, etc., that we were talking about, and generally in the case of the banking sector of the United States, you can say that, one of the things that happened at the end of the 2008 financial crisis, when it occurred, people did, no matter how much Alan Greenspan tried to dissimulate before various agencies, including Senate banking committees and so on. Oh, I was so surprised. I thought markets worked really well. I was wrong, etc. But in reality, at the end of the day, there was a certain amount of regulation. And one very big piece of regulation was the Dodd-Frank bill. And what the Dodd-Frank bill tried to do is it tried to make the banking system more resilient. And it did that by saying, you must have X amount of high quality debt in your possession as your asset, is so that you should have whole bonds, high quality corporate bonds or government bonds and so on, in order to pass various regular stress tests and essentially to pass muster as a viable bank. So these banks ended up keeping a lot of government bonds in their portfolios. And so the financial system and the financial regulators had learned one thing, which is that the banks should be made more resilient. But now they will have to learn another thing, which is that so-called high quality assets may not actually be so high quality if circumstances change. In this case, inflation returned to the United States in a big way. Federal Reserve started raising interest rates, and therefore the prices of bonds that were bought in an era of low interest rates started plummeting, and therefore essentially making the yields much higher. And this plummeting in the value of bonds is what ended up putting these banks, the Silicon Valley Bank and the other banks that collapsed recently. And by the way, another learning factor, the United States government could not possibly have bailed them out, because the fact of the matter is that the American public knows, the US public knows, that the last time it's the banks that got bailed out. So any government that does it again is going to face an enormous amount of popular disaffection, possibly even very severe popular unrest. They have already had, the feeling that the working class is being shafted has already produced phenomena such as Trump. In the past, of course, we had Occupy Wall Street. Of course, these are politically very different ones. But the fact, what I'm trying to say is that the fear of popular discontent, popular disaffection, particularly with an election looming, is what essentially ensured that the government could not easily be openly seen to bail out banks as it had done in the past.
Yes, very well said. And thanks for adding that note. I think it's an important context to add as well. I want to invite everyone watching or listening to check out Radhika's book. You can download it for free as a PDF. I will link to it in the description below. And in the next part, we will continue our discussion of her chapter on neoliberalism, and in particular, the economic situation today and the lessons that we can learn from the 1970s. I invite everyone to follow Radhika's work at the International Manifesto Group, also at the Geopolitical Economy Research Group, and you can follow her on Twitter at Rad Desai. Anything else you'd like to mention before we conclude here?
No, that's great, Ben. Thank you so much for having me.
It's always a real pleasure, and I want to thank everyone who watched or listened. Please subscribe, and we'll see you all next time.